Hello, everyone, and welcome to the 2016 Market Outlook. I'm Adam Koos, Portfolio Manager and President at Libertas Wealth Management Group in Columbus, Ohio. This is a series of screencasts that we do every quarter or so, typically every quarter, unless there's some big reason to do something intermittently. But hopefully you can walk away from today with some information, good information about the stock market, bond market, just the market landscape in general. Maybe get some insight for your own portfolio. And if you're one of our clients, hopefully it can give you some insight as to why we are doing what we're doing right now, what our strategy is, and what our plan is for your money. So first of all, before we do anything else, let's make sure that you have your screen optimized. At the bottom right-hand corner here, you're going to see a couple buttons. And what you're going to want to do is you're going to click on the little gear button with the HD symbol next to it. That'll pop up a window with a drop-down menu in it, and you should be able to click that drop-down menu. It'll pop up a bunch of different options for quality, and what you want to do is you want to click on the one with the highest quality. In this case, in this example up here, 720p was the highest quality. But the higher quality, the better. It just makes viewing the charts a whole lot easier than a lower quality film. Just a couple quick things about us. First of all, back in 2011, Financial Advisor Magazine ranked us as one of 8 portfolio managers in the country in Financial Advisor Magazine's 2011 Research All-Star Team for Portfolio Management and Research. And then also, if you're one of our clients, you probably know this already, but whether you want to look up some more information on what we've done, whether it be on Market Watch, Fox Business, U.S. News and World Report, and so on, you can find more of what we do. We're a regular on Market Watch as well. One last thing, we are a fee-only firm, and that's really important to us, and obviously it should be important to you whether you're a client or not. Any of the information that I'm going to share here today is going to be about as unbiased as it gets. Now, it's important to understand, and I'll say this later, it's important to understand that we are not trend predictors. In other words, we're not market timers. My job is not to try and predict what the market's going to do tomorrow, next week, or the next month. But as a fee-only firm that legally cannot take commissions from our clients, the only way we get paid is through either flat fees, hourly fees, or through AUM, what's called wrap account fees. There's no reason why I would give any advice on this screencast or in any other market commentary we do that would be for the better of our pocket. As our portfolios go up in value, so does our income. As our portfolios go down in value, so does our income. So it's obviously in our best interests to ensure that we're losing as little as possible and capturing as much of the upside as we possibly can as well. Okay, so let's get into the bulk of information here. I found this article. It was actually a video back on CNBC posted it, and it was pretty interesting. 2015 was the hardest year to make money in 78 years is what they had said. So obviously 2015 was not a fun year to be in the market. It was a hard time to find any place to make money. And the trends in either direction, whether it was positive or negative, were hard to capture, whether you were long the market or short the market. In fact, the people who probably did the best were people who were either shorting small cap international stocks or shorting commodities. But at the same time, after watching the market do so well for so long, I'm sure it was pretty difficult for anyone to short commodities or even short international stocks. But especially commodities because they had done so poorly for so long. Of course, you start thinking, when's the bottom going to come here? So the bottom didn't come, obviously. And here's a quick chart that just kind of shows the 2015 price performance of the different indices that represent these different asset class groups. And you can see here on this little dialog box on the left, U.S. stocks were down from price to price, January 1st to December 31st. Down 0.73%. If you owned bonds, believe it or not, you were down in bonds on 1.92%. And large cap international stocks, so these are large companies overseas, down 3.48%. If you were in any small company international stocks, you were down about negative 18.05%. And then, of course, commodities, which, depending on whether you owned oil, natural gas, or say one of the better performing commodities like silver, you were still down 7 to 8%, or is down as much as say 57%. But the average for the DBC in this case, which is the proxy I used, is commodities being down last year 27.59%. So my whole point here on this slide is to basically say that if you were diversified to use that word diversification, then, your portfolio had it worse off than just owning stocks and bonds. In fact, any attempt to diversify away from stocks and bonds just drug your portfolio down further above and beyond that of, obviously, stocks and bonds not exactly performing all that well last year. Moving on, this is something that's somewhat concerning, I guess. So this is Stock Trader's Almanac, which I read regularly. And what you're looking at here is the average gain based on election years. So you can see here the post-election year, so the year after an election, the average return since 1941 has been 5.7%. The midterm election year has been 6% on average. The pre-election year is typically the best year of the election cycle and has been up about 15% per year. Last year, as I just showed you a second ago, last year the market was down from January 1st through the end of the year 0.73%. Now, this doesn't include dividends, but that's not the point. The point here is that we can normally expect a really, really good year for pre-election years, and that just didn't happen. And to make matters worse, aside from the market being down in a year that's normally really good, election years on average are up 4.8%, or said another way, of the 4-year election cycle, the election year is the worst year of the 4. So I'm not sure what that means going forward. All we can do is look backward at statistics and try to draw our conclusions, but let me take things one step further here. So there's only been a handful of times, and you can see here, 1920, 1940, 1960, 1988, 2000 and 2008, and then today, of course, where there's been an 8-year election cycle. In other words, a 2-term president. Again, from Stock Trader's Almanac here, what's interesting about this is that of the 8 years, you can see this black line and how horribly the market has performed in that 8th year compared to up top, which is all election years averaged out amongst one another. So when you look back to 1920, that 8th year was down 33% almost, 1940 down almost 13%, 1960 down 9.3%, 1988 was the only good year, the only positive year, and it was only up 2.6%. Year 2000 went down 6.2%, and of course, the one we remember all too recently is the 2008 market cycle, down 33.8%. And prior to President Obama, there have been 6 previous presidents, as you can see up here, that served in 8th year in office. Wilson, Roosevelt, Eisenhower, Reagan, Clinton, and Bush. McKinley was elected to a second term, but he was assassinated his 5th year. Nixon, obviously, was also elected his second term, but resigned with the whole Watergate scandal. But making matters even worse, if you've read my market commentary this past couple weeks, 2015 was the worst year, I should say, since Germany invaded Poland, which is a big deal, obviously not a great sign. Moving on, this is a really nerdy chart. All I want to show you here is that the Santa Claus rally, the SCR, this is again from Stock Trader's Almanac, so the Santa Claus rally, which is the end of December, is supposed to be a positive time for the market. But this year it wasn't, and these are all a bunch of years where it was negative. But in 2000, the Santa Claus rally was down 4%, 2008 down 2.5%, and 2016 down 2.3%. The next column here is called the first 5 days. So first 5 days of the year are pretty important. It's just a good indicator historically speaking. And what we're looking at is that in 2000, it was down 1.9, 2008 down 5.3. This year, the worst start in history for the stock market, down 6%. So you can see when you compare all these numbers, and you can feel free to pause, rewind, or kind of go back and digest this information yourself. But as you digest the information, you can see here that 2016 ranks right up there with 2000 and 2008. Again, no promises that we're going to see a big bear market begin or a market crash, but I think that it's at least something that we should pay really, really close attention to in light of all these other things that I'm sharing with you today. Again, worst start in history. So as of Martin Luther King Day, the market was down about 8% year to date. Obviously, the market's been even, continued its volatility since then. And one of the things I think is interesting that I see on the news and in articles that I read is that, people are saying, well, as the market goes down, the fundamentals keep getting better. It's getting more value. There's more value. Well, of course there's more value, obviously. As the market goes down, everything gets cheaper, but I'm not so sure you want to buy this market all the way down the hill. I think people learned their lesson in the last 2 crashes that way. So just because it gets more valuable because it's getting cheaper doesn't mean you should continue buying as the freight train goes down the hill here. This is just the S&P 500 looking back 1 year. And what I want you to pay attention to is this blue line here is the 50-day moving average. So it's the average movement of the S&P 500 over 50 days. And the red line is the average movement of the S&P 500 over 150 days. So it's a short-term average, or a short-term, call it curve, over a long-term curve, just to kind of give us a really good idea of how things are trending. And here, if it were a 50 or 200-day moving average, we call this a death cross. But you can see how the blue line crosses below the red line, which is a negative sign, and then it crosses right above the red line here, indicating higher prices back in mid to early December, and then just crossed right back below it again this past week. So I said peekaboo up here because we only saw a brief moment in time where the 50-day moving average was actually above that of the 150. And again, that's normally a positive indicator, but it's obviously reversed right back down again. Furthermore, if you look at the bottom of the chart here, you can see that we've seen not only new intraday lows, but now we've seen new closing lows at 1859 on the right over here, going all the way back to the August lows, which is not a good sign. Again, what we want to see in a positive trending market is we want to see higher highs and higher lows. So again, digest that for a second, but higher highs and higher lows, that means that we're in a positive trend. What we don't want to see is lower highs and lower lows, and especially lower lows that are of significant price points going all the way back to levels of support, such as, in this case, the lowest point in 1 year, going back even further than that. So that's important. Another thing, this is a little bit more speculative because volume does play a key here, but if I draw a line here, one of the things I noticed as I was looking at some what are called OHLC charts is a potential bearish head and shoulders pattern. A head and shoulders pattern is defined by a left shoulder like you see right here, and kind of a sell-off, and then a reclaiming of that positive trend, creating somewhat of a head, another sell-off, and then a right shoulder that has to be lower than the previous high, which would be the head, going all the way down. And then from there you can draw a neckline at the low points. And what you want to see is the market bounce off that neckline and reverse back northward. But in this case, it didn't. It actually continued down, broke through the neckline. So while this is, again, a pretty strong bearish signal, volume does play a key. And but in light of everything else we're talking about, and I'm going to keep saying that over and over again, no one of these indicators should be treated as a reason to make a decision for your portfolio. But in light of all the different indicators and all the different charts, I think that's where it makes a whole lot of sense to kind of evaluate these different things and determine how much risk makes sense for you in your portfolio. So moving on, this is a longer term chart that goes all the way back to 1996. And the point here is that when we're looking at the ceiling that the market tried to break through here and twice, it was finally in 2013 able to claim new highs. Now that old ceiling that the market broke through back in 2013, technically speaking, becomes the new floor going forward. So we obviously don't want to see the market go that low. In fact, most of you probably have zero interest in participating in anything between now and then anyhow. Nobody wants to see their portfolio go down that low, but especially if it got to that point and cracked through it, that would be extremely significant. But again, I would hope that you'll be taking a lot more conservative action in your portfolio should we get to that point anyhow. Switching gears a little bit here, this is the stock market over history when you compare it to before the Fed announces a rate hike, which I'm not sure if any of you know, but this is the first time in December since 2006 that the Fed raised rates. And you can see here the average return for the 30 days prior to the hike was actually up. So on average, the market goes up before the hike, and then slowly over the next 60 days goes down. What we saw this time around was the market going down up until the hike prior to 30 days. And since then, it's just gone down in even steeper fashion since then. So again, I think this is pretty significant in the grand scheme of things. Okay, so this is a little bit more difficult to explain, but I'll try to keep things simple here. This is what's called a bullish percent chart, and a bullish percent chart simply measures the numbers on the right here and left are the percentage of stocks on a higher high. If it's an X's, that means it's going up. In other words, the percentage of stocks on a higher high are going up and improving. If it's an O's and going down, that means that the percentage of stocks on a higher high is going down or declining or weakening. And what we're looking at here is all equity funds, that's mutual funds and ETFs, the entire universe, plotted on a chart and showing us basically the direction of the trend of those on a higher high. And what we're starting to see here for the first time in many years, really going back to 2008, is some significant declines in this number. You can see how it bounced around here between 2010 and 2015, but in 2015 here, August, September, it rebounds, and for the first time again since 2008, we see a lower low right here at 62%, and now only 58% of all mutual funds and ETFs are on a higher high. Said another way, 42% of mutual funds and ETFs are actually on a lower low and actually weakening going forward. This is a chart I pay a lot of attention to, but there's usually really no reason to pay attention because the market's been doing so well for so long, there just hasn't been any reason to evaluate it. But now there's come a point where it's time to evaluate this chart. And what it is it's a comparison between the SH, which is the inverse S&P 500. So in other words, if you bought the SH and the market went down 5%, you would make 5%. So it does the opposite of the S&P 500. And what I'm doing here in this chart is we're comparing the SH to the S&P 500 just to kind of see how the relative strength comparison works. So to just quickly illustrate what this chart means is if the chart is in O's, if it's going down, that means that the S&P 500 or owning the stock market is better than shorting it. If it's in X's, that means being short the market or owning the inverse is better than owning the stock market and being long the stock market. But what we really look for isn't so much the columns. I don't care so much about whether or not it's weakening or strengthening. What I really care about is whether or not we get a higher high out of this chart. Think of it like a win in football or baseball or what have you. So we haven't had a win, so to speak, on this chart in a long, long time, and we're literally days potentially away from seeing the first win or the first higher high or a buy signal, in other words, on this chart, which would indicate some serious strength of the short S&P 500 versus the owning the S&P 500 itself. So said another way, more simply, if this thing moves up one more box, if we see one more X printed here on this chart, that would be a pretty strong indication that it might make sense to hedge or start shorting the market going forward for a period of time. This is a similar chart, except instead of looking at shorting the market, we're talking about owning bonds versus the market. So again, if the chart is in O's and going down, that means that it's better to own bonds, or at least the strength of bonds are strengthening versus that of stocks. And if it's in X's, it means that the strength of stocks is going up, or in other words, strengthening versus bonds. What we care most about, again, are the lower lows here that you see, or in the case back in 2008, the higher highs, which indicate that the bond market was significantly stronger than that of the stock market. So you can see the last time we saw a win was way back in 2009, and then you can go back and see 2008, we had a few wins, but it wasn't, since then, there really hasn't been any sort of wins on the winning record of that when comparing a football game versus bonds and stocks. But now, again, just like the previous chart we looked at, one more box here, one more X right here at this 5.9957 would indicate the first win for bonds versus stocks that we've seen since back in 2009, which again would be significant. All right, let me back up here. I'm going to try and wrap up. One of the things that we really pay a lot of attention to at our office when it comes to whether or not it makes sense to be in cash, whether or not it makes sense to be in the market, or maybe somewhere in between, is to look at the different penalty flags, as we call them, that we need to watch for to determine whether or not it makes sense to be in the market, out of the market, or somewhere in between. So first of all, the one at the top in the middle here. So defensive asset classes giving relative strength buy signals or wins over offensive asset classes. Right now, what we're seeing is utility stocks starting to outperform the stock market, but not because they're doing well, but more so because stocks are going down and utility stocks aren't doing a whole lot. Same thing can be said for cash or money market or bonds. The reason why we're starting to see cash, money market, and bonds doing well on a relative strength basis, or a winning, so to speak, versus that of stocks, is because they're just not doing a whole lot and stocks are doing worse. So it's not like we're seeing these asset classes like defensive investments doing well and outperforming and making all this money. It's just that they're not going down as much, or they're not going down at all like stocks are. The second one, trend charts of major indices, or indexes, however you want to say it, turning negative and important support areas violated. So whenever you start to see the different major market indices like the S&P 500, the Dow Jones Industrial Average, the NASDAQ, when you start to see these charts turn negative and break their positive trend lines, that's another reason why we might see a penalty flag go up, and it might indicate some defensive action. Narrowing of leadership from individual sectors. Leadership has definitely been narrowing. We're starting to see the market, when it goes up at all, we're seeing that what's pulling up the market are fewer and fewer sectors, industry groups, and subsectors. So that would definitely be a penalty flag that's on the field. The next one here is positive trend indicators below the 50% level. And what I mean by that is there's another chart that I did not show you today, but it's basically a chart that shows us the percentage of stocks on the NYSE or the percentage of stocks on the S&P 500, whichever we want to look at, that are on a positive trend. And what we've seen is that not only is this trend below 50%, but it's trending down and it's weakening. So again, yet another penalty flag sitting on the field here that would indicate defensive preparedness or defensive posture. And then last but not least, lower tops in bullish percent charts. Again, we looked at one of the bullish percent charts a second ago. Again, that one's the one that indicates the percentage of stocks on a higher high versus the percentage of stocks on a lower low. And again, we're seeing lower tops and lower lows in the bullish percent chart. So again, a penalty flag that's definitely laying on the field here. So just to recap, defensive asset classes are giving buy signals or wins over offensive classes. That's 1 out of 5. Trend charts of major indices are definitely turning negative and breaking their support levels and trends. That's a 2nd. Leadership's definitely narrowing. That's a 3rd. PT indicators or PT charts, positive trend charts, are declining and below 50%. That's 4 out of 5. And lower tops as well as lower lows in bullish percent charts. That's 5 for 5. So for the first time in more than a few years, we see all 5 of these major indicators. And there's more than just these 5 major, by the way. There's a lot more. But these are the 5 major indicators that we look at when determining whether or not it makes a lot of sense to start moving to the sidelines, which is exactly what we've been doing this past few weeks. A fun quote I saw the other day. Dr. Phil, he says, "Don't wait until you're in a crisis to come up with a crisis plan." And I think too many times when we do speaking engagements, we say this a lot, but, we say, don't wait to step on a landmine before you determine, how to get through the minefield. Take your time. Don't run through a minefield here. And, you got to be really careful in this kind of market environment, as far as, how much you're staying invested in the market and, how much risk you're taking in your portfolio. And everyone's different. It's like a fingerprint. Every portfolio is different. Every person's different. Everybody's retirement situation, their pensions, income, expenses, everybody's different. So every portfolio should be treated differently as well. But with that all said, let me show you just briefly what our portfolios look like today and kind of what we've been doing. So what I'm going to show you here is just what our portfolios look like right now and where we might be going in the future. So first of all, the Libertas portfolio, this is our aggressive model. It might not look like it because it's actually the one that holds the most amount of cash right now. And the reason for that is this portfolio is 100% individual stocks. And as these individual stocks break down, which it happens a lot like speedboats, they turn with quick velocity. And when they stop out, I've been selling them, and then we have not been replacing those stocks with new investments. I've just been, for the most part, raising cash, which is why we have roughly 58% in cash in that portfolio. The Liberty portfolio is our growth portfolio. You can see here we got about 72% invested in the market right now, about 8% in bonds, which is what fixed income represents. And then we've got 20% that we raised in cash down here at the bottom. And again, in both of these cases, all these portfolios are starting to raise more and more cash. The Freedom portfolio has no individual stocks in it. We've got 71% in the market. We've got 27% in bonds and 2% in cash. So the allocation is pretty similar between these two middle portfolios when it comes to risk versus safety. And then last but not least, our conservative portfolio, the independence portfolio, is currently invested about 56% in the market, 42% in bonds, with 2% in cash. Now, where I see this going forward, as I like to say to our clients all the time, we cannot and will not buy at the bottom and sell at the top. That's impossible. That insinuates we have some crystal ball, and I do have a crystal ball in my office, by the way. It just doesn't work. A client bought it for me as a gad gift years ago. But anyway, what we're going to do is the idea here is to buy on the way up the hill when positive trends are in place, capturing ideally most of the upside. And then furthermore, when the market starts to roll over and starts to turn downward, when it looks bad and we start seeing signs of weakness, we want to take profits off the table because, making a profit is enough. You have to keep that profit. But we have to wait for things to break down, and as those stock trends break down, as those ETF trends break down, we start selling them and getting out of the market as it makes sense, looking at a bunch of different indicators. But it's also important to understand that this is a dimmer switch, not an on-off switch. In other words, it's not like I said earlier, it's not like we see the S&P 500's trend break down, so we just jump out of the market and put everything in cash. Not only does that not make sense, but you'd only be guessing. That's not a strategy, just jumping out of the market. That's just an emotional panic button. And if you're right, you got lucky. And if you're wrong, you'll probably be sorry for it later. What we do right now, we have all of our money, all of our clients' assets invested in either the top 2 or top 3 asset classes here. So what that means is domestic stocks are still ranked number 1, but not by much. Bonds are ranked number 2, but very, very close behind stocks for the first time in years. Cash or money market is ranked just behind bonds, but again, very, very, very close to both bonds and stocks. International stocks, on the other hand, foreign currencies, commodities, those are at the bottom. We completely avoid them. We only owned international stocks last year for a short 2-month period of time or so in early spring. We didn't touch any currencies, and the only commodities that were purchased all year were little bottom fish plays where we were trying to make a profit off an oversold bounce or something along those lines. Whether it worked out or not, we, again, largely avoided the commodities sector. That includes gold, energy, and so on. So the whole point here is this is concentration, not diversification. We want to concentrate our money, our investments amongst the top 2 to 3 asset classes. And when I say 2 to 3, what I mean by that is if you're in one of our more aggressive portfolios, you're staying in the top 2. If you're in one of our more conservative portfolios, we use the top 3. As these asset classes rotate and weaken, let's just say domestic stocks falls to number 2, number 3, and so on, we will rotate and strategically shift the weight of our portfolios out of domestic stocks, as we have been, like I said in the previous slide, and into more defensive asset classes. And if things get bad enough, like the short versus long S&P 500 chart I showed you, if things get that bad and they start to look parabolic, then at that point we will start hedging and looking to profit on the downside in the market if things look long-term like they're going to get pretty bad. This is a list of sectors, and it's not the ones we own necessarily. Right now, it's just an image to kind of explain that what we're doing is we're buying in the domestic equity market. We're buying the top stocks in the top sectors, or we just buy the top sectors via an ETF. And again, as domestic stocks start to fall out of favor, assuming that's what happens, then we will obviously start paring away and selling the sectors that are underperforming, industry groups that are underperforming and are causing the biggest drag in the portfolio, holding on to the ones that are the strongest. Same thing with bonds. What we're going to do here is we're going to hold on to the strongest bond positions. If bonds become the number 1 asset class, that and cash, let's just hypothetically say, obviously most of our portfolios are going to be invested in bonds. Municipal bonds have done really, really well, and they continue to hold their trend. Tips have started to look okay. We own some tips, but long-term government bonds, things of that nature. So as time goes on, we're just going to have to see what happens. Again, we're not going to predict the trends. We're going to follow the trends. And as long as the trend is up, we're going to hold on to our winners. And if things start to break down, we obviously trim our losers. So again, we want to chop our losers off as fast and as short as possible, letting our winners run. So if the market gets so bad, or continues, I should say, to get so bad to where it's metaphorically hailing and raining and there's lightning clouds, at that point, in order to avoid seeing our portfolio get hit by lightning, sometimes the best place to be is in the locker room, or in the expensive seats under cover, in the loge box, trying to keep our players from getting hit by lightning and keep from losing money. But again, hedging could be a possibility in the near future as well. So that's all I've got today. If you have any questions, please, by all means, send us an email. You don't have to be a client to ask a question. We're not the salesy types at our office, so if you have questions, you just want to talk, we love this stuff. So if anything, once you open that door, we probably won't shut up. If you want to check out our website, you can subscribe to our market commentary, which I typically write about once a week or so. You can do the same thing. I'm not the best at posting things on Twitter and Facebook, but a lot of times when I'm writing commentary, what I'll do is I'll post charts and graphs like the ones you've seen today, and with little comments before the market commentary comes out if I have time. So if you want to follow us on Facebook, you can do so at the website up here on the screen. You can follow me or Libertas Wealth Management Group on Twitter. Again, check out our website. So thank you so much for your time. I hope that you're having a good start to the new year, with the exception, obviously, of the stock market. And I'll come back to you with more commentary via email for those of you who sign up in the near future. And then, of course, come second quarter, I'll put together another screencast a lot like this one, give you an update, and we'll talk more then.